Okay, let's get started. Please note, oh, by the way, this is Scarp. How can anyone use a kiss and waterbed approach to understand the basic elements of financial growth strategies and the tools within these different areas? So let's go to the next page and get into this little subject a little bit more, because you know this is just an introduction. Note what it says here. The kiss and waterbed methodology for understanding how to use accounting tools and economic indicators using the Wall Street Journal or the FT, the Financial Times out of London, to develop an understanding of financial management. Well, that's what my book's about. And let's push up a little bit higher. Go back up to the top where you see KISS. It's an acronym. If you've been around, you've seen it before, and it goes by Keep It Simple, Stupid. Okay, you're smart. I'm stupid. Well, the main point here, of course, is that the book is established so that we have a common set of financials, income statements, balance sheets, etc. So as you're going through the different sections and you want to reference back, and you will need to reference back to get a feel for what I'm trying to get across to you, back into a common set of income and balance sheet, and it makes the understanding easier. Well, it makes it easier for me. The other thing is the waterbed, and the main thing being here, you will see that, in fact, the next slide will show that I have 12 elements I push, 6 on the accounting side and 6 on the economic side. And while we're talking about it, let's push over in that. The first section deals with the overall view of financial management, the accounting and economics. And the chart I'm getting ready to show you will be the KISS approach. The waterbed approach is that if you make a tweak in any one of the 12 areas, it affects the rest of them. And what is financial management? It's bringing together and having an understanding that finance has two sides. As you can see right below there, the accounting two elements, and then it drives into the economic and economic indicators. Well, let's look at the model for sure now. As you can see, the model is before you. The caption at the top, my overall model for understanding financial management principles. And again, in finance, we have two sides. We have the accounting side and we have the economic side. And that's what the question all the way at the bottom says there. What is financial management? Well, financial management is bringing both of these elements together. The accounting tools, and if you look up, you will see all the way to the top what financial tools should a manager use as a guide, and we'll definitely cover all that in the book and a little bit in what the presentation I'm giving you now. On the other side, which is the economic side, you can see how to read economic trends, short and long, and relate this knowledge to your personal. Keep it personal, because I think people learn better when it's personal to me. And it goes on to say, or business decision process. How does this model relate to the cost of capital? Well, the economic side is always moving because we're be talking about the prime rate, the discount rate, Fed funds, Freddie Mac kind of rate, and the economy is pulsing. And I'm going to push you in the direction of understanding which way the cost of money is moving. And that's part of my book also. But as we know, the cost of money is constantly pulsing, and that would drive into the left-hand side here, down in the left-hand corner where it says cost of capital, debt. If the cost of money is going up, of course, you're going to have less profit. If the cost of money is going down, marginally, you're going to have more profit. Well, the concept here is that the economic side of the model influences the accounting side. The accounting side, changing in the budgets or the capital decision process, will move it more. Well, let's move on, because this is just an overview of the book. Next thing you see is section 2. Basic financial statements, glossary of terms. Now, that's what's in section 2, the basic financial statements used in annual reports, and there are 4, no normal to it. You have your income statement, your balance sheet, your cash flow, and your changes in equity position. What is an income statement? You will find out it is a statement of profit and loss, all income subtracted by all expense, giving you profit, and we'll work that issue. Balance sheet is to tell you what your firm is worth today. The assets on one side, and of course the liabilities and capital structure on the other. Glossary of terms, general accounting and financial terms, guides to investment terms, very general kind of area because there's always a lot here. And also for any of you that may be in government contract, some of those terms. That's Section 2. Section 3, you will see, is financial planning and controlling. And now we're going to bring in, or I'm going to bring in, budgeting and managing. Managing a budget. You will see that when you're a small firm, you put just a principal budget. As you get larger, though, it's more involved. It's a review process, but please never beat people up with budgets. Make them real. The first one you will be seeing will be operating budget. Think about it as a projected income statement and make it real. I think the worst thing that we can do with budgets is to want growth 20 times more than we can really do it. Make it where people can make it. In the sense, if you say we can go 10%, hey, that's an achievable goal. But if you go 20, is that an achievable goal? That comes out later on. The next one here, of course, is cash budget. And of course, cash is king. And this is going to be relating about real money coming in, real money going out, and there's different facets here. The capital budget. Well, the capital budget is a listing of approved programs through the capital decision process, the internal rate of return, the net present value kind of concepts, that once you get on that list, this is approved, we have to have the money for it, and it moves on. We will develop that in more than just a few places. Then the last one there is the balance sheet projection. And that balance sheet projection is, this is this year, what it's going to be next year, but realize what this really is doing for you. If you're growing in revenue, you need to grow in a balance sheet to support the increases in revenue, i.e., if you're doing $1 million, which is a very small number, but I just used $1 million, and you have a current balance sheet supporting that, what happens if it jumps to $10 million? Well, just think about inventory. If you jump tenfold, you can't hold that inventory at the current amount. It's going to have to increase to support that level. That is Section 3. Section 4, the comparisons of financial statements. Two areas here. How do you do an analysis approach? What kind of techniques? Notice we have comparisons. You can compare financials either in absolute dollars, as noted here, or percentages increase or decrease, or comparisons in ratios. And mainly, I'm going to be coming from the income statement and the balance sheet comparisons between each, and then cross over. Then the other comparison statements is, do we do a horizontal, which is just up and down, left and right, vertical, and budget to actuals. I think of the three there. When you have a budget and you're growing, you definitely want to ensure that you do a comparison on a monthly basis, and you have the leaders who are responsible for that to do the comparisons, and you help lead them through the process. And we'll talk more about that as we get deeper, or for sure when you get in the book. The next one. To me, there are really three major tools in finance. More than that, but for me, well, there are really four, but the ratio analysis, the weighted cost of capital, the capital decision process, and a good understanding of bonds and how you understand present value and what is called future value. And we'll definitely be into that. But notice here, ratios. No, ratios don't give answers, they generate questions. And questions can be a good question or a challenging question. Questions don't necessarily have to be negative. We're moving in a good direction in this expense area. Well, question, that's a good thing. However, the question is, why are we doing so well there? Or vice versa. Notice the ratios we're going to be dealing with is the ratio categories, the efficiency ratios, the leverage ratio, profitability ratios, and the market ratios. The main thing being here, there's a family of ratios, be it current or debt, whatever it may be, and it's definitely covered in this particular section. Trends and comparison analysis. Trends. Where am I moving with the company? Comparisons. Very important. How do I compare to my competitors? And how do you get that information together? And I have something on that. Limitations of ratios. Limitations of ratios, and I want to go back to what I said already, is that it doesn't give you answers. It gives you observations and questions. Is our trend moving in the right area? And when you compare us against the industry averages, are we doing good or bad? Good section, a lot to be developed here. I've done a lot of work here, and I'm very happy with it. Now we see section 6, and here we go. Working capital, cash management. Can't say it enough. Cash is king. Cash is king. Lord, cash is king. And we'll work within the text, net working capital, the management of working capital, the flow of working capital, the administrative current assets. And it goes all the way down through the hedging. Notice where it says temporary versus permanent, which is in a very important area and concept to understand, and also a break-even analysis. What always amuses me, no matter what book you go to, it can be marketing, it can be statistics, it can be math, it can be accounting, management. We always go to the break-even analysis, and I definitely have no exceptions, because we as individuals, and I have to reflect that my knowledge has gained from my students and from the good people who have written before me. Let's go on to the next section. Section 7, cost of capital. Notice it says internal and external. Well, if we don't go out for additional monies, what is our cost of capital today? If we go external, how much is that going to cost? And it's in the framework of budgeting and managing the types and sources of capital. Okay, that could be debt, preferred, common equity. Common equity is stock and return earnings, if you're at that level. Borrowing working capital. When do you do it? Today, or do you develop it over time? You develop it. Borrowing the group capital for growing, the permanent. And then it moves on to market risk, overview of risk. And risk is so important in finance, the mitigation of risk. How do you mitigate it and what to look for? Of course, we get into the cost of capital, and I'll repeat myself here. There's 3 areas. Debt, long term, preferred if you have those kinds of stock, and common equity, which is inclusive of your common stock and return earnings area, treasury, sunk funds, whatever comes in here. There's a lot here. And then we go with the weighted cost of capital, and I kind of lay it out for you. Moving on, section 8. This is the granddaddy of them all. In finance, I remember what really turned me on when I started looking and said, oh, I don't know, I have accounting background, I have a finance background, and I have an economics background. But what turned me on with all 3 of these areas was this process. How many times in our life have we said, what is the answer? Well, this can give you an answer. And it deals with capital budgeting. It deals with cash flows. It deals with terminal cash flows, the cost of capital, what is the hurdle rate, which is inside of there, and then the ones that make it happen, accept and reject criteria. We'll cover the payback method, net present value, profitability index, and the internal rate of return. No, the 2 main players here are net present value and internal rate of return. This is good. This is a good section. I like it. I'm biased, of course. Section 9. Now we have lease or buy. This is a good section in the sense that this is a different way of borrowing money. So you got a brand new business and you want to go into business. Can you afford to buy a building? No, you can't. However, you can lease it. So leasing, you can kind of think of is a different way of borrowing. Types of leases will be covered, advantages of leasing, disadvantages, go in line. The federal tax treatment of leases, limited, but it's definitely in consideration. Accounting treatment of leases, and then of course I have a brief cost analysis of lease versus buy. And this is an interesting area because sometimes what we don't understand is how much better would it be to lease a piece of equipment than versus a buying. And the real trick here could be in the amount of maintenance you would have to pay for if you had to take care of it or put it into the lease and whoever owned the equipment would do it. But different area, more to develop there. We are now at the end of this narrative or summary, and just to recapture, my main ideas about financial management go in two areas. I believe finance has two disciplines within it. One is the accounting and the tools that you use, and the other is economic and how to understand the flows of the cost of money moving up or down. KISS approach, keep it simple. Smart people, no. Keep it simple, stupid. Very good acronym, because in my mind, the simpler you keep things, the easier it is to understand and the more effective your actions. You get too involved, you get to analysis by paralysis, and that is not good for anything. Waterbed, again, there's 6 elements in my approach for accounting, 6 for the economic side. And when you move or something moves the economy, it affects the accounting tools. What is financial management? I'm going to constantly beat you with that in the book. It's bringing together accounting and economics. And the accounting tools as stated there, the economic indicators, I have this section, plus I have another website that's attached here that deals with how to read about the cost of money. Is it going up in the short run? Is it going down in the long run? What is my actions? How do I know this? Well, I deal with that in my narratives that will be coming out 3 times a week, mainly with the Wall Street Journal, and also I will bring in the Financial Times when I think it's appropriate or someone asks me about it. On the other side of that, along with the book comes the voiceovers, and you may want to add that to the overall price. Anyway, thank you very much for your time. Thank you for going through this, and you have a prosperous, quick day. This is Scarp. All the best. Cheers.